All right, settle in, grab your coffee or whatever poison you prefer because we need to talk about something brutally simple that most people are desperately trying to overcomplicate. You see all this chatter about how well corporations are doing, how the stock market is soaring, and everyone's feeling all warm and fuzzy. Well, let me tell you, it is like watching a kid eat an entire cake before dinner and then wondering why they re-sick later. It is unsustainable. It is built on a mountain of debt, a truly staggering amount of borrowed money, whether you are a government, a corporation, or just some dude trying to make ends meet. The rules of debt eventually catch up to you, and those big tech companies, the ones we used to think were swimming in cash, yeah, they replaying the same game, taking on more and more debt just to keep the lights on and fund their grand visions. It is all borrowed future, not real sustainable growth. Now, let us talk about the grim reaper of all things debt, interest rates, bonds, debt, whatever you want to call it. It all dances to the tune of interest rates. And I am sorry to be the bearer of bad news, but if you've been paying attention, you've seen the 2-year, the 10-year, and the 30-year yields all breaking out. What does that mean in plain English? It means interest rates are more than likely going higher, and investors, bless their little hearts, are demanding more money to take on the same level of risk. This is not a good sign, folks. Not with all that existing debt that needs to roll over, not with all the new debt that needs to be taken on at these increasingly higher rates. This right here is probably the single most important chart I could show you, because it is shouting from the rooftops that we are in deep, deep trouble. All that irresponsible borrowing, all those delayed consequences, they re-arriving right now. They may be partying on the stock market like it is 1999, but this is the early warning signal that the party is about to be crashed. The bond vigilantes are back and they are not messing around. So how does all this impact regular people, your average Joe and Jane trying to pay bills? Well, inflation, right? It means you have to spend more just to maintain your current standard of living. And at the level of inflation we're seeing, people are having to borrow money in 4 easy payments just to feed their families. That doesn't exactly instill confidence in the future, does it? But hey, there is your tale of two cities. It is stark. It is obvious. And what is supposedly holding this whole house of cards together is consumer confidence. Don't you worry though, the corporations are raking it in, earnings are through the roof. They remaking more money than ever. Yes, inflation benefits them, surprise, surprise. But here is the kicker. US inflation officially rose 3.8% in April, eroding people's paychecks. That is the consumer price index, the official number. Do you really think that is the real number? Because I don't. They jury rig things to make it look better. But honestly, since 2021, and let us be real, since 1913, US wages by design never keep up with inflation. Nominal wages might see a bump, but in real terms, the average worker is losing ground. This is incredibly important because Main Street does not live from asset appreciation. The 1%, sure, but Main Street, no. So when you look at that bottom purple line on the chart after inflation, real average hourly earnings, is it any wonder that people are suffering? Because frankly, by design, when inflation rises faster than wages, living standards decline, or individuals take on more debt to try and keep their heads above water. And to be honest with you, inflation pressures, they seem to be escalating, not calming down. What do you think? Let us look at the producer price index, the wholesale inflation numbers. These haven't trickled down to your grocery store yet, but producer prices matter because businesses eventually pass many of these higher costs on to you, the consumer. And don't you worry. They have to protect their profits, but that means inflation pressures can continue building underneath the surface of the economy, and we can see it yet, because it is still in the producer price index that will come down. But look at this. That 6% print has triggered a very important pattern shift. Let me show you what I mean. This chart shows producer prices breaking out. Just like those interest rates were breaking out to the highest level ever. This is a big deal because commodities sit near the beginning of the economic chain, and you can have these paper prices that hide a lot of ills until they can because when raw material costs rise, those higher prices have to move through the system, through manufacturing, transportation, food, every single aspect of the global economy. And that is why I say this is all just heating up. This is another breakout, and it creates even more pressure on households, reducing your purchasing power. And at the same time, higher interest rates mean that the bond vigilantes are beginning to notice this inflation risk. Just like I showed you, but what about the craziness happening in the gold and silver markets? Because I know all of you are asking, why isn't gold rising? Why is silver rising, right? Well, we re-looking at the spot contracts, but let us just take a look at this. Stronger than expected rises in consumer and producer prices raise concerns that the Fed may need to increase interest rates in the short term. Okay, so while I know that people watch the spot gold and silver market and think that truly represents gold and silver, it is understandable because that is what we were taught. But like inflation, Paper markets dictating the price, frankly, that is all by design as well. And they admit it, it is not me just saying it or pulling it from some airy-fairy site you read when they set things up, and they admit that all of this is by design. And even though that is in the process of shifting, we've been talking about that for almost a year and a half now. Wall Street logic is this. Why would you hold gold? It doesn't pay interest. Bonds, debt, that is better. Well, gold doesn't have to pay interest because it runs no counterparty risk. It is the single safest thing that you can do, according to the bank. For international settlements, which is the biggest bank, it is the central banker's central bank in the world. So in theory, bonds or debt are more attractive for investors than gold and silver because bonds pay interest. But I do like to ask you this little question. This is my $10 trillion Zimbabwe note. If I had a bunch of this debt and it paid me a bunch of this, can you tell me what good this would do? Because frankly, a trillion times zero is still zero. So let's look at what is happening on the technicals, because these are contracts, right? And you can kind of see a wedge forming here. This is just a 1-year contract. Now, I would like to point out to you that it is substantially higher. The silver spot contract is substantially higher today than it was just 1 year ago. And if you recall in our conversations, I said there are a few things that can happen, and one of them that is happening is that the spot silver contract is staying inside of that narrow range, giving that 200-day moving average an opportunity to catch up. But look, it is still 18% above that 200-day moving average. That doesn't mean overvalued, it does mean overbought. Because they can create as many contracts as they want without limitations. So it doesn't reflect the true fundamental value of an ounce of silver. But last week I showed you how during this period of volatility, some very large players are standing for delivery on those silver contracts. So let's take a look at it, because that is what you are looking at. This is the 6-month silver contract. Now you can see there is a lot less silver for delivery out, isn't there? Okay, but in the meantime, silver prices are more volatile because they are telling you that there is a major shift that is going on. Here is the technical chart on gold, the 1-year spot contract. Again, I will point out that it is substantially higher than it was. The contract is just 1 year ago, and we still 5% above the 200-day moving average, which means that the spot gold contract is no longer overbought. But you can see how it is sitting. It is creating that wedge, like a wedge of cheese, right? And we see if it breaks out above or below. And all of this is just from paper contracts, not the real stuff in both gold or silver. And remember, everywhere around the world, the global central banks are accumulating gold. This is the 6-month COMEX gold. Can you see that somebody's taking delivery? Somebody is taking delivery even with the price pullback, and I can tell you exactly what those contracts are because I didn't put that data in there. But is all of this volatility about keeping you away from buying gold because ETFs to technology demand physical buyers? This tells us that it is a structural trend, not just a short-term trade around the world. Retail investors were drawn to gold's price momentum and safe haven appeal, driving bar and coin demand up 42% year on year. So I want you to keep this in mind, that those paper contracts, that is one thing, but bar and coin demand up 42% year on year. Demand in China surged 67% year on year, considerably higher than the previous quarterly record. And by the way, do you really think these central banks are going to be honest with us about what they really accumulating? Because other Eastern markets, including India, South Korea, Japan, also saw an increase in bar and coin buying, contributing to the ongoing structural shift in gold demand. Bar and coin demand was also supported by strong growth in the US and Europe, up 14% and 50% respectively. Can you see the difference between the contracts and the physical markets, right? You and I are not working in the contracts because they don't mean anything. That is all counterparty risk. But we live in the real world. And what you are looking at here is that bar and coin investor demand. So I want to begin with the tale of two cities. Again, we began with that, and let us just take it to conclusion today. I believe there is not one doubt in my mind that we reliving through a tale of two economies. Wall Street experiences asset inflation, woohoo, party. Main Street experiences life inflation, and what is really interesting to me in this is in my generation, we were taught to accumulate assets. And frankly, those assets did me. Thank goodness I had them. There were times in my life when if I didn't have them to sell to feed my children or other circumstances, what would I have done? But these new generations that are coming up have been taught to collect experiences. Well, you cannot liquidate an experience if you get into trouble. You can leverage that experience for other things. But one side of the economy benefits from using those financial assets. The other side struggles with rising everyday costs, expenses, and that pesky inflation that impacts that declining purchasing power. And as debt rises, inflation pressures continue and confidence weakens. More and more people are turning back. This happens every time to physical gold and silver, because in the end, real wealth is not measured by how high a market can rise. That can mean absolutely nothing. Real wealth is measured by security in food, water, energy, security, barterability, wealth preservation, community, what we redoing here, and shelter. And so that is why I love my Tuesdays, because I get to spend them with you, and you guys are what makes me feel really wealthy. And so now we take some questions.